Welcome to the deep dive. Today, our mission is really to cut through the headlines and dig into the recent third quarter 2025 results for one of the world's biggest auto and property insurers. We're not just skimming the surface here. We've got the detailed 10Q filing, the full investor call transcripts, everything we need.
That's right. And, when you see numbers this big, the real story often isn't just the top-line revenue. It's more about the underlying mechanics, the strategic choices that are driving these margins. And what we found here is, well, it's a fascinating look at hyper-efficient operations and, maybe more surprisingly, a huge mandatory customer payout, which is directly linked to some specific legislative changes.
Okay, right. Let's get straight into that with the core metrics then. The big one, always, is underwriting performance. Their consolidated combined ratio is 89.5% for the quarter. Now, for anyone maybe newer to this kind of analysis, could you just quickly ground us? What does that combined ratio actually tell us?
Absolutely. So the combined ratio, it's really the key measure of profitability for an insurer. You basically take the claims they paid out, add their operating and acquisition costs, and divide that by the premiums they collected. If that number's over 100%, well, they're losing money on the underwriting side. Below 100%, they're profitable. Simple as that.
And this company, their goal is 96% or lower. So hitting 89.5% for the quarter, that's pretty elite performance.
Oh, it's truly exceptional. I mean, really top tier. And their year-to-date figure is even tighter, 87.3%. This is just pure underwriting efficiency driven by their massive scale.
Speaking of scale, the growth numbers are just huge. Net premiums written grew 10% in Q3. Year-to-date growth is 13%. But the unit volume, that really shows how aggressively they're moving. Policies in force, PIF they call it, grew 12% year over year.
Right, and that PIF growth, that's the actual number of active policies. It translates to 4.2 million more policyholders, which covers nearly 7 million additional vehicles.
Wow.
In just 12 months. That's enormous growth. And when you manage that kind of growth with those phenomenal margins, well, you get results like their trailing 12-month comprehensive return on equity. It stands at a really substantial 37.1%.
Okay, but here's where the story gets a bit complicated, right? This thing we're calling the Florida paradox. You've got this incredibly profitable company, yet they had to book a massive $950 million policyholder credit expense just in September. How does that work? Why did being so successful lead directly to them, essentially cutting a check for almost $1 billion back to their customers?
Yeah, it's a perfect illustration of what it means to operate in a highly regulated industry. That massive credit, that $950 million, it wasn't voluntary, it was mandatory. It's because of Florida's excess profits law.
A law that penalizes you for being too profitable. That sounds counterintuitive.
It does, doesn't it? But essentially, yes. The law says if the company's actual profits are more than 500 basis points.
That's 5 full percentage points?
Exactly, 5 points better than the underwriting profit margin they originally filed with the state regulators. And this is measured over a 3-accident-year period. Then that excess profit must be returned to the active policyholders in Florida.
Okay, that is an extraordinary mechanism. So what happened? What caused this huge, unexpected surge in profit in Florida that actually triggered this rule?
It really came down to successful legislative action by the state, specifically the passage of House Bill 837 back in 2023. This bill fundamentally changed the state's tort system. Key things were shifting to modified comparative negligence, which basically limits who can sue for damages. And it also altered the rules around something called one-way attorney fees.
Ah, okay. So the state itself effectively fixed a huge source of insurance risk, a source of cost inflation. And those benefits just flowed straight to the company's bottom line faster than anyone really expected.
Precisely. You see the direct results right in the source documents we looked at. Average loss costs for Florida injury claims, down between 10% and 20%. And maybe even more dramatically, the number of lawsuits on personal injury protection or PIP claims just plummeted, down around 60%. Now, the company had already planned rate reductions. They'd done 2, another was coming, but the drop in their expected claims costs was just, as they put it, more pronounced than expected.
Wow. Let's talk about the scale of that mandated payout again. $950 million. You had a really interesting comparison point in the sources.
Yeah, the comparison really helps put regulatory risk in perspective against, say, physical catastrophe risk. So that $950 million accrual, it added 4.6 points to the combined ratio just for Q3. A huge impact. Now compare that to Hurricane Ian back in 2022, a devastating storm, billions in damage across the state. Well, that catastrophe only reduced the calculated excess profits equation, the thing triggering the payout, by about $750 million.
Wait, hang on. Are you saying the positive financial impact, the immediate benefit of successful tort reform, was actually bigger in this specific calculation than the negative financial impact of one of the costliest hurricanes in recent history?
In the context of how Florida's excess profits law works, yes, that's what the numbers show. It really underscores that for insurers, the legislative and regulatory environment, well, it can sometimes be a larger, more immediate financial swing factor than even a massive natural disaster, especially in their largest market like Florida is for them. It's a fundamental risk shift.
That's a staggering insight, truly. Okay, so let's shift gears now. We've talked about this sort of passive profitability, profits delivered by external legislative changes. Let's move to their active, aggressive growth strategy. Because they are operating in a super competitive market, yet they keep spending big and growing fast.
Right, and their whole approach seems to be defined by scale and efficiency. They believe, probably rightly, that they have the best pricing models because of their data advantage. So the strategy seems to be grow as fast as we can, as long as they meet a very strict internal efficiency target.
Okay, so they spent $1.3 billion just on advertising in Q3. That's up 10% year over year. My question is, how do they justify pouring that much money into ads without just destroying that beautiful 89.5% combined ratio? What's the logic there?
Well, they clearly view advertising not just as a quarterly expense, but as an investment in future retention. They monitor their cost per sale every single month. And the rule is simple. As long as that cost stays below their target acquisition cost, meaning, they acquire each new customer efficiently, then the spending is justified. They're essentially trading some immediate short-term margin points for massive long-term policy retention and that compounding growth effect.
And the growth isn't just random, right? They seem heavily focused on this Robinson customer. What is the Robinson customer?
Yeah, Robinson is their internal term for the multi-car and multi-product household. So think people who have both their auto insurance and their property insurance, homeowners or renters, bundled with the company.
Okay, and why the intense focus on growing that specific segment?
Well, two big reasons. First, it represents a truly staggering addressable market. They estimate it at $230 billion, where they currently feel they have a relatively low share. Huge potential. But maybe more importantly, these multi-line customers, they just don't switch insurers as often. The switching cost feels higher, so they're statistically stickier, less likely to shop around every renewal. Plus, they often represent a more preferred risk segment overall. Capturing these Robinsons is key to driving that long-term profitability and retention they're aiming for.
And a big part of capturing that market relies on their tech advantage, their product development. Tell me about their philosophy there.
Their philosophy seems to be just relentless iteration. It's all about matching rate to risk better than anyone else in the market. They're constantly increasing the pace of their model updates. You see them moving rapidly, like from auto version 8.9 to 9.0 or property 5.0 to 5.1. Their sheer scale gives them this vast amount of data, which they leverage to segment risk incredibly granularly. The goal is to price every single customer, perfectly.
Right, which brings us to that specific example you mentioned, the Auto Product 9.0 update. What was significant about that one?
Auto Product 9.0 introduced something they called embedded renters insurance. They explicitly recognize renters insurance as a, and I'm quoting here, potential gateway product. Basically, it's a low-cost, usually high-retention product. It's an easy way to start a relationship with a customer early on, maybe when they're younger, and immediately pushes them towards that valuable multi-line Robinson status. Gets their foot in the door before that customer even thinks about buying a house. Smart move.
Smart. Okay, before we move on completely, just a quick check on future tech. Are they seeing any real impact from autonomous driving yet? Self-driving cars and all that?
It's interesting. They said they've been actively monitoring autonomous driving trends since way back in 2012, but management was clear on the call. They haven't seen any significant impact yet that actually reduces the number of miles driven, not even in areas where you see a lot of, say, Waymo vehicles operating.
Yeah.
So while it's definitely something they model for the long-term future, it's not really affecting their immediate loss trend forecasts right now.
Got it. Okay, let's dive deeper now into the mechanical side of things, the underwriting mechanics, the loss trends that actually generate these huge margins. This is where we get into things like reserve development.
Yeah, and this is a really critical point of analysis for any insurer. The company reported total favorable prior accident year development of $1.068 billion year-to-date in 2025. That number is just massive, especially when you compare it to only $199 million they reported for the same period back in 2024.
Wow, okay. And nearly five-fold increase in favorable development year over year. So For the listener, can you break that down? What exactly is favorable prior accident year development, and why did it jump so incredibly high this year?
Sure. So it basically means that in previous years, they set aside money capital reserves, expecting to pay out a certain amount for future claims related to accidents that happened in those prior years. Favorable development means those claims ultimately ended up costing significantly less than they had originally anticipated, than they had reserves for. So that difference, the money they didn't need to spend, gets released back into profit now, essentially making the performance from those previous years look even better in hindsight.
Okay, so why the huge jump this year? Was this a genuine surprise that they just got lucky? Or does it maybe reflect a very conservative reserving approach that's now unwinding?
The sources suggest it's probably a combination of factors. Personal auto was the main driver, contributing $910 million of that favorable development. And the primary reason, again, circles back to Florida. It was the lower than anticipated severity, meaning cost per claim, and frequency, number of claims, both coming in lower than expected due to those tort reform effects we already discussed. On top of that, they also mentioned seeing lower litigation defense costs across most states, not just Florida. Now, insurers like this tend to reserve conservatively anyway, so when a major trend, like a big legislative reform, dramatically reduces risk, well, the reserves they built up under the old, higher-risk assumptions suddenly look massively redundant, and that flows back as favorable development.
Okay, that makes sense. Let's break down the overall personal auto loss trends then, excluding the comprehensive coverage part. How are those two main levers moving severity and frequency?
Right. So severity, that's an average cost per claim was actually up 7% in Q3 2025. And this increase was predominantly driven by an 11% rise, specifically in bodily injury, or BI coverage reserves. They link this directly to the ongoing reality of higher underlying medical costs and also increased plaintiff attorney representation in states outside of Florida. So some cost pressures remain.
So medical inflation, legal system costs, those are still pushing costs up in some areas, even while overall efficiency improves. What about frequency, the number of claims?
Frequency, which is the sheer volume of claims being filed, was actually down 2% in Q3. And management links this decrease directly to that successful shift in their business mix we talked about. As they acquire more of those multi-line preferred risk customers, the Robinsons, their overall pool of policyholders tends to file claims less often. Better risk selection paying off.
Okay, makes sense. We should probably touch on commercial lines too, because they actually moved in the opposite direction on growth.
Yeah, that's right. Commercial lines saw negative net premiums written growth. It was down 6% in Q3 2025. But this wasn't necessarily a sign of poor underwriting. It seemed more related to a mix of operational factors and market conditions.
What were the main drivers there?
Two main things stood out. First, they saw decreases in the projected mileage for their transportation network company business. TNCs, ride-sharing services. Since premiums for TNCs are often based on miles driven, lower projections mean lower reported premium volume. And second, they apparently made a strategic shift towards writing shorter, 6-month policies in some of their core commercial auto markets instead of annual policies. That naturally impacts the quarterly premium volume reported compared to booking a full 12-month policy's premium upfront.
Gotcha. Okay, one last piece on the risk side. Disaster risk management. Catastrophe losses were way down this quarter, $219 million total versus over $700 million last year. How do they protect themselves against those really big worst-case scenarios like major hurricanes?
They have an extremely robust reinsurance program. It's quite sophisticated. They use what are called property per occurrence excess of loss contracts. So, for example, outside of Florida, they keep the first $200 million in losses from a single event. But inside Florida, recognizing the higher risk, they only retain the first $75 million. They transfer the risk above that to reinsurers.
Ah, so that retention limit in Florida is significantly lower than elsewhere. That makes sense given the exposure.
It does. It reflects their understanding of the extreme catastrophe potential there.
Mm.
Overall, they have $2.0 billion in reinsurance coverage just for property losses. And that actually reaches $2.2 billion when you include the Florida Hurricane Catastrophe Fund layer. That structure is designed to protect those huge underwriting margins even if a massive storm hits, or even if, ironically, the regulatory environment forces a $950 million profit payout like we saw.
Right. Okay, let's pivot to the balance sheet and how they deploy all this capital they're generating. With so much retained profit, their financial position must be incredibly strong.
Oh, it's rock solid. Total capital stands at $42.3 billion, and their debt to total capital ratio is only 16.3%. That's well below their internal policy ceiling, which is set at 30%. Management was quite clear on the call, signaling that they have, and I quote, excess capital at this juncture.
Okay, excess capital. So where does that excess capital actually go? What's the official pecking order, the deployment hierarchy?
Yeah, they laid it out pretty clearly. First priority always is reinvesting back into the core business to drive more profitable growth. So maintaining that tech edge we talked about, fueling the ad spend to keep acquiring customers efficiently. Growth comes first. Second priority is share buybacks. They use these primarily to offset the dilution that comes from employee equity compensation. But also, crucially, they use buybacks opportunistically, as they say, when they believe the company's shares are trading below what management views as their intrinsic or fair value.
Right. And the third priority on that list is the variable dividend.
Correct. That's something the board considers annually, usually towards the end of the year. And given that clear signal about having excess capital, well, it certainly suggests that the board meeting coming up in December will likely involve a robust discussion about a potentially significant return of capital to shareholders, probably beyond just the regular buyback program.
Interesting. Okay, finally, what about the investment portfolio itself? With $42 billion in capital, how are they managing those investments? Are they taking big risks there?
Not at all, actually. The portfolio is managed very conservatively. It's highly liquid. It has a short to intermediate duration, averaging just 3.4 years, which means it's not very sensitive to big swings in interest rates. And get this, they currently hold $52.9 billion, yes, billion with a B, just in short-term investments in U.S. Treasury securities. That makes up 56% of their entire investment portfolio. So extremely liquid, very safe, ensuring they can meet any unexpected claims surge easily, regardless of their operating cash flow at the time.
Okay. So bringing all these different threads together then, the ultimate source of this insurer's really elite success isn't just one single thing, is it?
No, exactly. It really seems to be like a three-legged stool, you could say. First, those sophisticated data models allowing for that near-perfect rate to risk matching. That's fundamental. Second, the highly efficient, high-volume customer acquisition engine fueled by that huge but disciplined $1.3 billion ad spend. And third, what really stood out this quarter is their sheer agility, the ability to instantly capitalize on massive favorable external shifts like that Florida tort reform, even if capitalizing on it comes with the unique complexity of a mandatory profit return.
Yeah, for me, the specific insight that really crystallized here is that fundamental tension these high growth, high margin regulated businesses face. They absolutely must maximize unit growth, the PIFs, and drive efficiency to achieve that critical scale advantage. Yet at the same time, they run the risk of bumping up against regulatory ceilings like Florida's excess profit law, which then forces them to constantly adjust their pricing downwards, even when their underlying risk profile has already dropped dramatically. It's a tricky balancing act.
It absolutely is. And, that leads us nicely into a final provocative thought for you, the listener, to maybe carry forward from this deep dive. If successful tort reform, like House Bill 837 down in Florida, can so immediately reduce insurance risk that it mandates a nearly billion-dollar customer payout in just that one state, what does that potentially imply about the inherent profit structure and maybe the pricing of auto insurance in other states? States that haven't adopted similar legal system changes. What might be the unseen cost baked into your own personal policy premiums that comes from operating within perhaps less efficient or more litigious legal systems elsewhere?
That really does reframe how you think about regulatory risk versus just, say, storm risk or accident risk. A lot to consider there. That concludes this deep dive. Thanks for joining us, and we'll talk to you next time.